Today we're talking about Mickey D's and its secret sauce coming up. Welcome back to the channel, guys. My name is Sean. If you're new here, and there are a lot of new people, which I'm very excited about, this is a channel where we talk about personal finance, investing, a little bit of real estate investing. If you're interested in following my journey to financial freedom, please consider subscribing. So a couple weeks ago, we talked about Walmart and Walmart Plus, and I was commenting about how Walmart was one of those stocks I remember from 2008 that just did really well in the 2008-2009 recession. And I wanted to see how it compared with its performance now doing this year. And we found that actually Walmart is kind of thriving again a little bit. Now, I mentioned another stock that I would get into, and the other stock that I remember from 2008 doing really well was actually McDonald's. There was something interesting about McDonald's when I was researching, and that is its price to book ratio. Its book value was very unique, let's say, and it kind of messed up my evaluation a little bit. So if you guys want to talk about negative book value and you want to skip to that part, I'll leave links in the description and in this video so that you can get there quick. Otherwise, I'm going to run through a little bit of a history of McDonald's, and we'll go through some of its current stats, and then we'll get to that. But before we get into talking about McDonald's, I need a little McCafe. Okay, so a really brief history about McDonald's. It's another staple, long-running stock with a great brand and a large brand following. It was started in 1940 by Maurice and Richard McDonald. They opened their first McDonald's then, and they incorporated this speedy service in their restaurant to really perfect fast food. In 1955, Ray Kroc comes along. He opens up the 9th McDonald's. He buys the brothers out of their equity and takes control of the franchise, and he begins to aggressively expand it. So he's kind of the person that you'll see a lot of people kind of attribute McDonald's to. McDonald's serves 68 million customers a day in 120 countries. It has over 37,800 stores. That is pretty impressive. It ranks 131st on the Fortune 500. And one kind of interesting thing that you maybe have already heard about McDonald's is that it holds a lot of value in the land that it puts its stores on. It actually owns a lot of that land, a lot of that real estate. And according to Wikipedia, it thinks that that land is worth about $16 to $18 billion alone. Another kind of interesting fun fact is The Economist, which is a magazine and website, uses something called the Big Mac Index, where it compares the price of a Big Mac in different countries to sort of illustrate that country's buying power. It's sort of like asking what the cost of a loaf of bread is, but it's using a Big Mac. That kind of illustrates how widespread the reach of McDonald's really is and how global they are. So we can see a lot of similarities here with Walmart and with McDonald's. There's a really big brand recognition. There's a willingness to adopt new technologies and modernize and keep up with the times. McDonald's always pays attention to trends in food and tries to stay current and give the customer what they want. And there's one more similarity when we look at how they performed in 2008. So if we look at the chart from 2008-2009, we see a late surge at the end of 2008 and a decline in 2009. And it sort of rocks between $52 and $62 for a while and starts to really steadily climb at the end of 2009. For the most part, it stayed even, and if you held onto the stock for any length of time after 2009, it was a positive investment. So there's a similar set of reasoning here. Along with the brand recognition and that drive to seek comfort in uncertain times, Big Macs work like Walmart in that they give some comfort food at a low price point. Recessions are times when people are saving money, so some of us might look to start saving some money in hard times by switching to fast food. Instead of going out to a restaurant, you might say, okay, I'm going to save a little bit of money and go to McDonald's. Now, I'll be honest, I didn't buy that argument until this year. I didn't eat a ton of McDonald's myself until this recession, and I probably had it 3 or 4 times. And for me, that's probably twice as much as I'd normally go. And I'm sure this is probably true for fast food across the board. So if we jump into the chart for this year, you can see that the stock did get pulled down with everyone else in the middle of March, but rebounded quickly in about a month. It surged and is doing a similar back and forth between $200 and the $185 mark, and right now it's up to $209. So it's even surged a little bit in the last few weeks. So I'll be honest, I don't own any McDonald's at this time, and I'm kind of kicking myself for it. Considering that I heard about it in 2008, I should have been ready at the start of this recession to go in and try to pick up some McDonald's stock. In bad times, this will definitely be on my radar, just seeing how it's performed in 2008 and now 2020. Keeping in mind also that 1/5 of McDonald's revenue comes from the rent that franchises pay for being on its property, which is a nice bit of insurance, so that even when things are tough, Rent's still coming in for McDonald's. You combine that with the company's willingness to innovate, and you have a pretty dependable stock that will stand the test of time. So let's just jump into the ratios really quick. So as of the recording of this video, the stock price is $209.51. Its dividend is $5, giving you a yield of 2.39%. It's got $156 million market cap, so it's a fairly large company. A P over E that's kind of high at 33.11, so that's a little bit of a warning for you. A PEG ratio that's 4.66, also a little high if you're looking for a growth stock, but I wouldn't say that McDonald's is necessarily a growth stock at this time. It's pretty big, so you might let that one slide. Operating margins are typically pretty good, and they were typically increasing, which is what you want. The last little bit, operating margin has been decreasing, but I feel like that you're going to see that across the board of fast food restaurants. So not necessarily something that I would be too scared of. Really quick, I'll just look at the free cash flow per share. It's 4.63, which is less than $4, but that's just from this last quarter. McDonald's was pretty strong. It was over $7 in the first quarter, so I don't think you're going to have an issue. I just use this as an indicator as to whether we know that there's enough free cash to pay the dividend, and I think so far you'll be okay. Payout ratio is a little bit high at 77.81, but again, this is more if you're interested in dividends. And while McDonald's is a pretty good dividend stock, if you're really into dividends, you might be looking at other things. Now let's talk about the price to book and current ratio, because this was really interesting. I couldn't find a price to book ratio because the book value seemed to basically decline and go negative, and I thought that was really odd, and I wasn't sure what happened there. Also, the current ratio was under 1, which was really surprising considering I thought this stock was pretty dependable and would be at least a little bit over 1. Now, normally you would look at the current ratio and say, well, that's not good. They have more liabilities than they have assets, but that is where we need to dig a little bit deeper with McDonald's. So what is with that negative book value? Is McDonald's in trouble somehow? Are they going to be maybe filing for bankruptcy or something? No, it's nothing crazy like that. We actually have a very similar situation to what we talked about when we looked at REITs. So the short answer is no, they're not in trouble, and here's why. So first off, McDonald's has chosen to buy back over $20 billion worth in common shares, and this will show up as a negative number on the balance sheet, but helps with the share price since it reduces the number of available shares. Now, if they'd chosen to use that money to pay off some of their debt, which a lot of economists said they should have done, then you would see the ratios kind of tip in a little bit more of a favorable direction. But chances are McDonald's was probably looking and seeing how the interest rates are so low. It wasn't really tempted to pay off debt when it was paying such a low interest and decided to buy back shares instead. Now, there's one more thing you really got to pay attention to that kind of affects these ratios, and it's what I mentioned earlier, in that McDonald's owns a lot of the property that the stores sit on. And lots of these properties are older than 20 years, and here's why that's important. Now, we know that McDonald's is an old company. A lot of the locations have probably been there for a super long time. I don't know of a lot of McDonald's that have ever closed down. Now, the other thing you have to know is McDonald's uses what's called a straight line depreciation on their assets or their properties. What that means is they'll depreciate that asset, their property, down to zero over 20 years. But we know from my video on REITs, by the way, I'll leave a link to that right here. We know from the video on REITs that by code, you have to account for your assets, but just because you've depreciated to zero doesn't mean that that asset is worth nothing. So you have all these locations of McDonald's that exist, they're worth billions of dollars, but they don't show up on the balance sheet. And that's where it kind of messes up your current ratio and your book value, because they don't show up on your balance sheet, so they're not accounted for and not taken into account in those ratios. So hopefully that gives you a little bit of comfort in knowing that McDonald's isn't going anywhere, and the reason why the numbers are a little bit wonky is just because we can't look at this like just a stock. You have to look at it as like a stock mixed with a REIT. One thing that you should really look at though in fast food is the money coming in from operations. More or less there will be a little bit of a hiccup this year with McDonald's because of the whole COVID thing, but overall you can see from its funds coming in from operations it was actually pretty healthy leading up to this, and now that stores are starting to open back up, I think you're probably going to see it do okay, and I don't really see it going anywhere. So would I buy McDonald's now? I would say I wish I bought it 3 months ago. I wish that I listened to myself from 2008 and said you should have looked at this sooner and bought it. I personally don't find it super exciting. I don't find fast food super exciting, but if you want a good dependable stock, or that's something you're looking for for your portfolio, this is somewhere I would go. I think I'm looking for a little bit more growth stocks now, so I'm not really putting McDonald's at the top of my list. But if you're looking for like a dependable stock with some steady growth over a long period of time, definitely check out McDonald's. Well, guys, I hope you've enjoyed the analysis. I hope I was able to explain why the negative book value thing isn't a big deal for McDonald's. Definitely check that out for other stocks. I'm sure this applies in a few other cases in different companies as well. Please remember to like and subscribe to the video to get the video out to more people. And if you have any ideas of stocks you would like me to look at, please leave them in the comments below. What type of things are you guys investing in? Have you invested in McDonald's? What do you think McDonald's is going to do for the rest of the year? Put those all in the comments below and let's talk about it. Until next time, have a great week, spread the wealth, and I'll see you in the next one. Bye.